While every retail trader is glued to a price chart wondering why XRP is moving while stock markets are crashing, Ripple just quietly assembled the most dangerous piece of institutional infrastructure in crypto history. And almost nobody is talking about it the right way. See, the mainstream narrative is XRP is pumping because the market is scared. Sure, that's the surface, that's the noise, but underneath that noise, three things just happened simultaneously that I haven't seen line up like this before. And when you understand what they actually mean together, not in isolation but together, the picture becomes very difficult to argue with. Pull up a chair. I want to show you what the signal actually looks like, right now. Welcome back. This channel is built on one principle: calm analysis over emotional reaction. We don't do hype here. We don't do fear here. What we do is take the raw information, strip away the noise, and show you the structural moves that most people won't see until it's already priced in. Today, we're decoding three interconnected developments. Let's get into it. Let me start with the hard truth that most XRP content gets completely backwards. People look at Ripple and they think payments company. Maybe they think crypto firm trying to get out from under the SEC. And for the last 3 years, that framing has made sense. But that framing is now dangerously outdated. What Ripple is building right now, in real time, is not a payments company. It is a regulated multi-chain financial operating system. And the distinction matters enormously, because the addressable market for a payments company and the addressable market for a regulated financial operating system are not in the same galaxy. Here's the mechanism most people don't understand. Every financial institution, every bank, every fintech, every corporate treasury holds assets across multiple chains, not just one. They might have Bitcoin exposure, Ethereum-based tokenized securities, Solana-based assets, stablecoin positions on Base or Arbitrum. And until now, they needed separate custodians, separate wallets, separate compliance stacks for every single one of those chains. That's not a minor inconvenience. That's a structural barrier to institutional adoption. Through their managed custody platform, Palisade, which Ripple now fully controls, they have launched support for the XRP ledger natively, plus Ethereum, Solana, Tron, Arbitrum, Avalanche, Base, Polygon, and BNB Smart Chain. One MPC secured custody layer, one policy engine, one API, one address that maps across every EVM-compatible chain. Think about what that means for a bank that wants to hold tokenized treasuries on Ethereum, run cross-border settlements on the XRP ledger, and manage stablecoin flows on Base. They used to need 4 vendors to do that. Now they need one. And that one vendor is Ripple. This is not a product update. This is a category expansion. Ripple is no longer competing in the payments corridor. They are competing for the role of institutional backbone across the entire multi-chain financial system. And once a client integrates those Palisade APIs alongside Ripple's payment and treasury stack, Ripple controls the custody, the liquidity, and the payment orchestration. You don't rip that out for a competitor offering 5% savings. You build on top of it. That is called a moat. Now let's do the math. Because math is where the emotional interpretation dies and the structural reality begins. The global cross-border payments market processes approximately $150 trillion annually. The Forex market clears $7.5 trillion every single day, and the total value of assets trapped in Nostro and Vostro accounts, pre-funded, idle liquidity just sitting there waiting to facilitate settlement, is estimated at $27 trillion locked up at any given moment. $27 trillion, doing nothing. That is the inefficiency that XRP's on-demand liquidity model is designed to eliminate. Instead of pre-funding accounts in every corridor, you hold XRP, convert on both ends, settlement in 3 to 5 seconds. The math on what happens to XRP's required price point when even a fraction of that corridor demand flows through it? That is a number most retail investors haven't run yet. Here's the calculation to sit with. If XRP is processing $1 trillion in daily cross-border volume, not the full market, just a fraction, and if transactions complete in under 5 seconds, and the average holding period per transaction is 5 seconds, then the required XRP in active use at any one moment is a remarkably small slice of total supply, which means to support that volume at current prices, you need an enormous amount of tokens in play. But as the price rises, you need fewer. The system becomes more efficient, which means a higher XRP price is not a headwind for institutional usage. It's a feature. Now, overlay this with Palisade. Ripple now earns managed custody fees, wallet provisioning fees, treasury automation fees, and on- and off-ramp fees across every single chain they support. This is not speculative revenue. These are recurring enterprise contracts. The more chains they support, the more assets they hold in custody, the more fees they generate, and the more capital they have to acquire additional infrastructure, expand into new corridors, and defend their regulatory position globally. The ETF inflow data confirms the institutional signal. We're looking at $52 million in XRP ETF inflows at a single day. Not a spike, a pattern. Consecutive days of institutional capital moving into XRP exposure. That is not retail FOMO. That is allocation. Those are two completely different things. While retail traders debated whether the XRP breakout above $1.44 was real, smart money was sending a very different signal through very different channels. Let's look at what's actually happening on the institutional level. First, Palisade isn't a startup Ripple is experimenting with. It's now Ripple's fully integrated managed custody and wallet layer. That means institutional clients interacting with Ripple's payment stack are now automatically operating inside a custody framework that meets MPC security standards, built-in AML, built-in KYC, compliance architecture that a regulated bank can put in front of their risk committee without embarrassment. That matters. That is the gate that has kept institutional money out of crypto for years. Second, look at what V-Lightup just did in Japan. This is a Japanese fintech that has launched a live, production-grade trade finance settlement platform built natively on the XRP ledger. Not a proof of concept, not a pilot. A live platform settling letter of credit transactions. Instruments that traditionally take days to clear, now settling in near real time using multi-party escrow on the XRP ledger. Ask yourself this: does a Japanese fintech building regulated trade finance infrastructure choose the XRP ledger by accident? Japan has one of the most rigorous financial regulatory environments in the world. The FSA does not look kindly on cowboy infrastructure. The fact that a Japanese fintech selected the XRP ledger as their settlement layer is a credibility signal that no press release from Ripple could generate on its own. And then there's Wormhole. Ripple's developer channel just highlighted the integration that allows XRP and XRP ledger-issued assets to move natively across 35 blockchains: Ethereum, Solana, Avalanche, and beyond. Cross-chain DeFi, cross-chain lending, cross-chain collateral, without wrapping, without fragmentation. One unified liquidity position that now has access to the entire on-chain economy. The co-founder of Wormhole said it directly. The XRP ledger is the perfect foundation for the future financial system. That's not a marketing quote. That's a builder who works across 35 chains, telling you where they see the structural value concentrating. Here's where the timeline gets interesting. And I want to be precise, because vague timelines are a retail trap. The Digital Asset Clarity Act and the broader U.S. regulatory framework are moving toward resolution in a way that was not credible 18 months ago. When regulatory clarity arrives, and the signal from multiple fronts suggests we are closer than the market has priced, the risk premium that has been artificially suppressing institutional allocation disappears overnight. Not gradually, overnight. Here's why that matters structurally. Institutional capital does not trickle in when the gate opens. It floods. Because the analysis has already been done. The allocations have already been modeled. The legal opinions are already in the drawer. They are waiting for the green light. When the light turns, you won't have weeks to position. The second catalyst on the immediate horizon, RLUSD's expansion onto Ethereum Layer 2 networks, Optimism, Base, InkChain, via Wormhole's native token transfer. This isn't RLUSD competing with XRP. It's RLUSD creating new liquidity venues where wrapped XRP becomes the premier trading pair on the other side. More venues, more pairs, more demand for XRP as the high beta asset riding on top of Ripple's regulated dollar rail. Ripple explicitly called this out. RLUSD and wrapped XRP pairs across L2s are the mechanism by which XRP gains deeper liquidity inside non-XRPL ecosystems. That is a flywheel, and that flywheel is beginning to spin right now. Now I want to talk about the window, because this is where I think most people watching this video are underestimating the situation. We are in the last phase of accessible accumulation. That is not a hype statement. That is a structural observation. When Ripple controls the custody layer for institutional assets across 9 blockchain networks, when ETF products in Canada launch that bundle XRP with Bitcoin and Ethereum in a single managed vehicle, when Japanese fintechs are settling live trade finance on the XRP ledger, you are no longer in the early adoption phase. You are in the infrastructure phase. And the infrastructure phase is the last phase where retail investors can position ahead of the demand curve. Once the regulatory clarity lands, the risk premium disappears. When the risk premium disappears, the price gaps higher, fast. The gap doesn't fill slowly. The gap fills at the pace of institutional reallocation, which is not slow. The tokens that move from retail wallets into multi-sig institutional custody during that window do not come back to market for a 10% gain. They are locked inside treasury management frameworks with 18-month minimum holding periods. They are gone from liquid supply. We are moving from an era of abundance to an era of scarcity. And the irony is that the clearest signal of this transition, $52 million in a single day of ETF inflows, a Japanese fintech choosing the XRP ledger for live settlement, Ripple controlling multi-chain custody, is happening right now, in a week when most retail investors are distracted by red candles in the equity market. The door is not locked yet, but it is closing. I know what some of you are thinking right now. This all sounds great, but my portfolio is still down. The market is chaotic. How long do I hold through this? That is the right question, and I'll give you the honest answer. Being early in a structural shift is uncomfortable by design. The market doesn't reward the impatient. It doesn't reward the loudest. It rewards the ones who understood the architecture before it became obvious. The red candles right now are not a contradiction of the thesis. They are the cost of admission. The equity market sell-off is creating a rotation, and some of that rotation is landing in crypto, because institutional investors are looking for asymmetric exposure that isn't correlated to their equity book. That rotation, small as it might be right now, is the early signal of a much larger capital reallocation that hasn't fully arrived yet. The technology hasn't changed. The regulatory trajectory hasn't changed. The institutional positioning hasn't changed. The XRP ledger is processing real transactions for real financial institutions building real infrastructure. VLightUp is live. Palisade is live. Wormhole is live across 35 chains. The question isn't whether you believe in the thesis. The question is whether you'll still be holding when the thesis becomes the consensus. Price is a distraction. Structure is the reality. And right now, the structure is the most compelling it has ever been. Ripple has custody. Ripple has compliance. Ripple has cross-chain reach across 9 networks and 35 blockchain ecosystems via Wormhole. A Japanese fintech is settling trade finance on the XRP ledger today. ETF capital is flowing in, and RLUSD is building the dollar liquidity rail that makes XRP the highest demand asset in the room. The signal is clear, but only for those who are actually looking. If this breakdown gave you clarity, subscribe and drop a comment below. Tell me, are you watching the noise or are you watching the structure? In a market fueled by emotion, we thrive on data and composure. Stay patient, stay rational. The math doesn't lie.